What's going on, guys? Alex here. We're back for another video. And in this video, I'm going to talk about the presentation sheet that I use when I'm presenting the options to the seller face to face. All right, so by this point, what I've done is sent them options via email. We went over those options via a follow-up call, and then it's time to go to the house and get the agreement signed. And I've already went over the one-page agreement when it comes to wholesaling lease options, the agreement that we use. And in this one, I'm going to go over a presentation sheet that I use right before I get the agreement signed. All right, it just makes it a little easier to get the agreement signed, in my opinion, when I go over the presentation form, because these are the same numbers that I use on the form, which is translating into a one-page agreement that allows me to take it to market based on those terms. Alright, so this shouldn't be too long of a video. Basically at the top I have the address, I have the details here, and I have this up here so that they're aware. I've also run comps. In this case I only had one comp that I was able to find that was similar to that one. And I also have the Zillow price and basically the range that I think that the house is worth. And I go into their minimum net. So I saw here that it was listed on the market, which means after a 4% commission, which it was listed at a 4% commission, they're going to net somewhere around $392. So my goal is to always help them net more than whatever it was listed at or is currently listed at. But some of these leads are going to be expireds, right? So if it's an expired, you can research all this information as far as what it was last listed at and what the agent was going to be compensated, which means they were going to net $392. All right. So if they're happy with $392, then they should be happy with $400K. Makes sense? I also got the PITI over the phone, and this is just going over. So this basically the range is what I think it'll be worth and why it's justified that we can get them $400 with our market. All right, so I basically have the two options. This is the wholesaling lease option. I call it an assign back because I'm assigning a tenant back over to them, and they're managing the process. In option 2, stay in, means that we would stay in and make the payment every month and basically manage the process until up to 3 years. I'll go over the term. In this case, I put 4 years. It's the headache-free option. This here is the net the most option. That's pretty much how I explain it. All right, so over here I put this is the price that we're going to offer to a buyer. We're going to put it on the market for $424.9. Usually you can increase the minimum net to the buyer. So this is the seller price. We're going to raise it 5 to 7% to the buyers because they're willing to pay a premium on it since they need time to qualify for a bank loan, right? We're dealing with lease option buyers who can't get qualified for a loan today, but when we do the screening, it comes back either 18 to 24 or sometimes more or sometimes less when they could be mortgage ready, and that's why they're willing to pay a premium on it. So this here is an anticipated down payment. Roughly 5%. I basically just take this number, subtract here. That leaves a net remaining of $402.9. And up front, the seller would keep $11,000 because we basically split this 50-50. This is the assign back option. And I would usually leave I'll have two arrows here, one pointing what the seller keeps, one pointing what I keep. And this here's what the seller keep is the $11,000. Which leaves them a total net when you add back $11,000 to the $402.9 of $413.9. All right, so notice how this is always going to be more than the minimum net most times. So in this case, they're actually going to net more than what they were expecting. The monthly is $2,500 to them. This is because this is what the market will bring. It's $2,500 a month, even though their PITI is $1,800. They're going to receive about $700 a month in cash flow with this option. And I put transparently, I make sure that they're aware that they're going to be managing the process. They're going to collect the check from the buyer. With this option, we're out of the picture once we find, place, and procure a buyer for them. This here's the term, so it's a much shorter term. We'll know this more once we get the screening back from the third-party company with Paul Ritter. And if there's a default, I tell them just to give us a call. We can put another buyer in there, or you can decide to basically sell it at that point or rent it. All your options are open to you. The ball's in your court. Option 2 is where we would stay in. And you can see here the price is much less because we're taking on more risk by guaranteeing a payment every month. When I say guarantee, we're not guaranteeing debt. We're just we're putting our name. We're basically making the payment every single month. Is what I mean by that. So they're going to net much less doing it this way. You can see here there's no down payment, and the monthly is equal to their PITI, so they're not coming out of pocket every month. So basically the payments made for them, they can move on, whether it's because they're moving out of state or just want nothing to do with the property. This here is usually the better option, even though they're going to net less, all right, because they prefer to have debt relief versus netting the most for their property. And here I put that they collect a check directly from us. We're basically their tenant buyer. They're well aware we're going to sublease it to another buyer, manage the process, get it done, and they'll net this here $370 at the end of the day, less whatever their mortgage is. The term here is going to be longer because in case there's a default, we would want to put another buyer in there, or if there's a vacancy, we would want to put another buyer in there. It just gives us time to guarantee this cash out. So 48-month longer term, usually the longer you hold the property, the more profit you make on it. So you want the term to be as long as possible. You can even put 60 months. Just be aware that a seller is going to want the term to be as soon as possible, right? One of the objections you're going to face is when will I get a cash out, right? And the sooner for them, the better. But the longer for you, the better, right? Because the more time you have, the more cash flow you get. So these are all negotiable, of course. This is just what we discussed over the phone, and generally what would be minimum profit standards for us. And you have to decide that. You have to decide what your minimum profit standards are for you, as far as upfront deposits, as far as monthly cash flow, as far as length of term. Those are all decisions that you'll have to make. So here I put that the loan payoff plus the equity net at closing. So what I'm saying here is that their loan's going to get paid off at closing, and they'll receive any anticipated equity once the buyer goes through with their financing. If default, we take care of it. What I mean by that is if the buyer were to move out or default on the term, then we would be on the hook, right? So let's say the buyer was anticipated to close in 24 months, but they're not ready to get their financing. We would either give them an extension because they've been making their payment, or because they're that much closer to getting to the finish line, then we would leave them in there. But if they just completely default or move away, then we would be responsible for the payment, even if it's not occupied, right? And the reason why we would want to do that is because there's profit in it in the back end. So I just mentioned that we'll take care of any defaults. You don't have to worry about it. This is the headache-free option. This is the net-free for your most option. All right, so that's pretty much how I explain it. I asked them if they have any questions and which option they're leaning more towards. Most cases it's option 1, especially from what we spoke over the phone. If it's option 2, I usually would refer this to an investor in my market. You could take it on yourself depending on your situation. I've gone over other videos why you would want to do either one, and going over the profit centers as far as the Excel spreadsheet that I provide. All right, so I might have went through this too quick. Let me know if you have any questions in the comment section. Again, it's pretty simple to explain. This is the easiest way to do it. Just to have, you can even do this on paper. I used to just write it out and have option 1, option 2. This is basically where you net most for it, as we spoke about. This is where we would. This is the headache-free option where you net less, but it'll be headache-free. We'll take care of everything for you. And that's really how you want to position it. All right. So again, let me know if you have any questions, and thanks for watching.